Hey folks, Ted from Independent Solutions here. Ever heard of the 363 rule? No, it's not a new dating app. It's how banks rolled back in the day, from the 50s to the 80s. Think of it like this. Bankers took in your hard-earned cash at 3% interest, then they turned around and loaned it out at 6%. Their reward, a cool 3% profit margin. Seems simple, right? This was the golden age of banking, my friends. It was a time when tellers wore hats and everyone trusted their local banker. Back then, banks mostly stuck to their knitting, taking deposits and making loans. No fancy financial instruments, no subprime mortgages, just plain old-fashioned banking. But hold on, was it really that simple? Was the 363 rule just a license to print money? Well, not so fast. Some folks argue that all this simplicity came at a cost. They say it stifled competition and innovation in the banking industry. After all, if everyone's playing by the same rules, where's the incentive to offer better services or lower rates? It's like going to a restaurant where the only thing on the menu is a grilled cheese sandwich. Sure, it's familiar, but wouldn't you rather have some options? Now, you might think that all these regulations would make banks about as exciting as watching paint dry, but here's the thing. Some folks back then argued that the cozy relationship between banks and regulators actually made them competitive. Think about it. If you're a bank and you know the government has your back, you're not exactly going to be pushing the envelope. Why rock the boat when you're guaranteed a steady profit? This led to a situation where banks weren't exactly falling all over themselves to attract customers. They didn't have to. They knew you didn't have many other options. It was like being the only gas station in a 100-mile radius. You could charge whatever you wanted, and people would have no choice but to pay up. So, while the 363 rule might seem simple on the surface, the reality was a bit more complicated. It was a system that created both stability and stagnation, and like any system, it had its fair share of winners and losers. Now, not everyone agrees that the 363 rule was a recipe for disaster. Take economist John R. Walter, for example. He argued that all those pesky regulations didn't actually put a damper on competition. Walter pointed out that even with the rules in place, banks still found ways to compete with each other. They offered different types of accounts, competed on service, and even got creative with their lending practices. He argued that the real threat to competition wasn't regulation, but rather consolidation within the banking industry. As bigger banks gobbled up smaller ones, it led to less choice for consumers. So, according to Walter, the 363 rule wasn't the villain some people made it out to be. It was simply a different era in banking, one with its own set of challenges and opportunities. Section 4, D. Young and Rice. Hold on, it's more complicated than that. But wait, there's more. Economists Robert D. Young and Susan Rice had a slightly different take on the whole 363 rule thing. They argued that while the rule might seem straightforward on paper, the reality was far more nuanced. They pointed out that banks were actually engaging in all sorts of activities that went beyond the simple borrow at 3%, lend at 6% model. They were investing in securities, offering new financial products, and even dabbling in international markets. D. Young and Rice argued that the 363 rule was an oversimplification of a complex industry. It was like trying to explain the internet by saying it's just a bunch of tubes. Sure, it's technically accurate, but it doesn't even begin to scratch the surface. So, while the 363 rule might make for a catchy headline, the reality of banking during that era was far more intricate and fascinating. Section 5, the 2008 crash. Maybe some rules are good? Fast forward to 2008 and the financial world imploded like a cheap tent in a hurricane. Suddenly all that deregulation that was supposed to unleash the free market looked like a really bad idea. Remember those fancy financial instruments I mentioned earlier? Well, they turned out to be ticking time bombs, and when they exploded, they took the global economy down with them. In the aftermath of the crash, there was a lot of soul-searching about the wisdom of letting banks run wild. Maybe some regulations weren't so bad after all. After all, you don't let people drive cars without seatbelts, do you? The 363 rule, once seen as a relic of a bygone era, started to look downright quaint. It was a reminder of a time when banks were boring, predictable, and well, maybe a little too cozy with regulators, but at least they weren't bringing the world to the brink of financial collapse. Section 6, Across the Pond. Did they do banking better? Now, you might be wondering how the rest of the world was handling all this banking business. Well, it turns out that the US wasn't the only country experimenting with deregulation. Australia and the UK were also hopping on the free market bandwagon. In Australia, they dismantled their four pillars policy, which had prevented mergers between the country's biggest banks. The result? A wave of consolidation that left Aussie consumers with fewer choices and, some argue, higher banking fees. The UK followed a similar path, deregulating its financial industry in the 1980s. This led to the rise of massive financial institutions, some of which played a starring role in the 2008 meltdown. So the lesson here, folks, is that there's no such thing as a free lunch, especially when it comes to banking. Deregulation might sound good in theory, but in practice, it can lead to all sorts of unintended consequences. And as for the 363 rule, well, it might not have been perfect, but at least it kept the financial system from going completely off the rails. And in today's world, that's saying something.